All right, good afternoon. Good afternoon. It is Monday, February the 9th, 2026. As most of you are aware, usually we record these videos in the morning. I had a sick kid at home earlier today, so I was kind of helping my wife with that. Got to the office, arrived at the office here, a couple hours later than I typically do. And at that point, rather than record the video like we usually do on a Monday morning, I was at that point there's already client work that needed to be completed. So here I am a handful of hours later here, kind of late in the afternoon, but I did want to get this video out just because it was another very eventful week in markets last week. And I could go a number of directions with the video today. I mean, we could talk about how a number of stock markets around the world are hitting highs right now in the face of what I would consider mostly negative media headlines. But you're seeing many equity markets hit highs. We could talk about a really bad week for cryptocurrencies, and now at this point, most cryptocurrencies losing 50% of their value just in the last few months. All right, yeah, I was actually really surprised. I looked at Bitcoin, obviously the most well-known in this space, and it's basically the same after this meaningful correction, crash, whatever you want to call it. I mean, it's basically at the same price it was 5 years ago. It has a small gain, but you would think just for it feels like it's been a good. If you didn't look at the chart, you would think, it's been. I thought it would have been a better 5 years for Bitcoin. Essentially, just a small gain now over the last 5 years with all the ups and more recently downs. But we could talk about gold, which rebounded a little bit this week after a dreadful week the prior week that we discussed. But the topic I kind of landed on, and I wasn't intending to do this, but it just so happened over the last week I've had 3 clients reach out independently and just ask the question. I saw the NASDAQ, right, and all 3 questions were around this same general idea. I just saw on TV the NASDAQ is still negative for the year, which it is. So the NASDAQ is negative for the year. How is my portfolio? I just looked, and it's 7% higher, 6 or 7% higher already this year, in 2026. Okay, so I basically received that same question in 3 different, very similar wording, and so I thought it was a good time just to. We don't get in great depth talking about investment philosophy and what we do at the office here. But yeah, I thought given those questions, hey, let's take a couple minutes and walk through what we call style factors or characteristics of businesses and the way we construct portfolios for the long run. All right, so so maybe the best way to do it. So if you just kind of think. Let's put there's thousands of businesses, of course, around the globe, publicly traded businesses, right? And so on the one hand, I'll put them over here. They're really exciting businesses. Okay, it'll be like a lot of your very innovative, cool technologies. I mean. Companies that change the world, right? So really neat softwares that are being created. A lot of AI, you would say, is over in that space right now. And then on the other hand, you have a different set of businesses that are more simple over on this side, right? So whether that's your food distributors, transportation, your consumer staples. Banks, maybe some forms of energy, right? And so companies on the technology side, coming back to the other side, typically these types of businesses are going, not all the time, I'm just making some general observations. Many businesses on the technology side are going to have really high research and development budgets. Okay, and just given the optimism and the excitement of these types of businesses over on the technology side, what ends up happening in the marketplace is these businesses tend to trade at what we call high multiples, right? So, a word you hear used more frequently, it's kind of, these are growth companies. They're growth companies, and so given the amount of earnings that these businesses may or sometimes don't have a profit, but so for the amount of earnings, they're going to have a stock price that is quite high, right? So high stock price in the denominator, lower earnings or book value. You can put a number of things in the denominator. So these are going to be your growth companies. The other side we have, some people refer to this as more value, right? Because they might have a good bit of profits, and their stocks might not trade as high because there's not as much growth expected. Okay, so why am I bringing this up? Why do we tie this all together? I'm going to pull up something on my phone, and I'm trying. This might fail miserably, but you could look this up on your own. But what I have here, if you can see the screen, you'll notice I highlighted the 3-month. So this is over the last 3 months. And this little matrix, if you will, this is showing the return of the U.S. market. So the U.S. stock market over the last 3 months, right? So not every company they don't go up and down together, right? So we call these different style boxes. But like we just went over, all right. So on this side, we're gonna have these are more value, okay, and then over here we have growth. All right, and then what I didn't bring up, of course, so you also have like large cap growth, and you have small cap growth, right? So and then in the middle, of course, we have more like a mid cap, and then in the right in the middle here, there's kind of like a blend between large cap, value and growth. Okay, but what's probably sticking out to you is those are some really big differences in returns just over the last 3 months. All right, so let's start over here because that's the one everyone's looking at. So over the last 3 months, in the U.S., large cap growth has a negative 7% return. All right, so this is when you turn on and Amazon is down a bunch the other day due to their I think it was a $200 billion investment in AI. The stock went down a bit. Okay, so that's just a small example. So we have large cap growth down 7%, whereas on the other side, large cap value positive 11.6% over the last 3 months. You gravitate down here, small cap value up almost 16% in the last 3 months. All right, so I mean that spread between, I guess it's hard to do things backwards, but 16% growth. 16% gain in small cap value as compared to 7% loss in large cap growth. That's a 23% difference in return in just 3 months. Okay, so how does this play into overall portfolios? Well, we usually don't get this nerdy and talk about this, but there's 100 plus years of data, people far smarter than I am, that have looked at return characteristics as technologies have changed over time. And what they found is in the long run, it doesn't happen every day or every quarter or every year, but in the long run, value, so again on this side, tends to outperform growth, but maybe a couple percent per year on average. Some years, tech heavy growth is going to do really, really well and outperform, but more years than not, it might not. Okay, so and really, like if you think about it, what the narrative that made the most sense to me in kind of understanding all these, as I've studied all these different investment strategies over the last couple decades, you can think of one reason for the long-term underperformance, if you will, of the growth component is a lot of investors, okay, and just the data shows, like investors get really excited about the new technologies because, I mean, stocks aside, like, these companies are really, really neat, really, really fun to invest in. These are the companies that are going to be all over CNBC. All right, but what ends up happening is, on average, your typical investor is going to overpay for the optimism on this technology side because the price you pay matters, right? So if it's a really, really cool technology like that's great, but if you're paying 100 times for the stock, whatever the stock price is, if it's 100 times higher than maybe a value company over here with consistent dividends, earnings, some of these companies over here are going to be more recession proof, and just in the long run, you get a little more outperformance on the value side. So what we do in portfolios, like, you want to own all of it. You definitely want to own the technology and all these pieces over here, but we just slightly underweight this. So we hold a little bit less of the growth side. We're gonna just hold a little bit more on the value side, and this is the very simple version of it, because you want to do the same thing not just in the U.S. but internationally in emerging markets. And again, we don't know which years that this will come to fruition. Like there have been plenty of times in history where the tech side will have multiple years of outperformance, but that's just where rebalancing comes into play, keeping everything in check, on target, where we want the portfolio for the best chance of long-term success. But why are portfolios outperforming this year? Well, it's this, right? So in knowing that, it's just our portfolios that we use for most clients, it's going to be an overweight on this side. And as you can see with the NASDAQ, which is going to be a lot of that large cap growth, we're just a little underweight that. We own more on the value side. So hopefully that wasn't too much. Just trying to explain some of the basics of the philosophy that why we think that this way to invest is best for most clients. So hope that makes sense. We're really excited. We got reviews that start next week. So a week from today, we'll send out one final scheduling link at some point later this week. So if you haven't scheduled yet, at this point, most of the openings are going to be in March. But we really look forward to seeing many of you and hearing about how the last couple months have gone and summer plans and all the fun things we go over. So questions, comments, concerns, please don't hesitate to reach out to our team. And we hope you have a great week. Thanks.